You are looking at two numbers right now. The first is the float, the slice of SpaceX that actually trades on day one. It is roughly 4% of the company, about $70 billion out of a $1.75 trillion valuation. The second number is the supply that will hit that same market over the next 6 months. It is not 4%. It is closer to the entire company minus what Musk personally owns. Those two numbers are not the same thing. And if you bought SPCX today, you bought at a price set by the first number. What you will own in December will be priced by the second. If you are a self-directed investor who did your research, read the float, saw the scarcity, and decided this was a clean entry, this is not a story about being careless. It is a story about which number the prospectus made easy to find, and which one it buried in the fine print. Today we are going to read that fine print out loud. Let's start with what the scarcity story actually looks like. On day one, SpaceX sells roughly 4% of itself to the public. At a $1.75 trillion valuation, that is about $70 billion of shares chasing an enormous amount of buyer demand. At the same time, Nasdaq changed its fast entry rules in May 2026 to allow a company this large to join the Nasdaq 100 within 15 trading days of listing. Passive funds tracking that index, QQQ and its cousins, are estimated by analysts to absorb roughly $30 billion of SPCX in the first month alone. $30 billion of forced mechanical buying chasing $70 billion of available float. You do not need a finance degree to see what that does to the price. It compresses supply, amplifies demand, and creates a number on a screen that looks like strong market conviction. It is strong. It is just not permanent. This is what I call the manufactured scarcity window. The float was designed to be too small to absorb the buyers. That is not an accident. It is a feature of how mega IPOs get launched. The scarcity is real on day one. The question is, what happens when it stops being real? And that is where the prospectus earns its reputation for fine print. If you subscribe to Salary to Strategy because you want to understand the mechanics that move prices rather than the headlines that describe them, hit the subscribe button. We read the filings so you do not have to spend the Saturday on SEC EDAR. Now let us look at what the S1 actually says about supply. Most people picture an IPO lockup as a wall. Insiders cannot sell for 180 days. Then the wall falls, supply floods in, price adjusts. Simple. SpaceX built something more sophisticated than a wall. They built a staircase, and the first step is already behind you. Here is the schedule directly from the S1 filing. The friends and family carve-out is 5% of the IPO shares, roughly $3.75 billion at the offer price. It carries no lockup, 0 days. Those shares were eligible to sell the morning the stock opened. So on day one, while you were reading headlines about a 27% pop and thinking you were competing against a scarce float, $3.75 billion of shares held by people who paid the IPO price are sitting there with no restriction on when they sell. That is the first step of the staircase. You may not have noticed it because it does not look like the lockup expiration stories you have read before. Then the schedule continues. After Q2 earnings expected around August 2026, insiders can sell up to 20% of eligible shares. 2 days after that report hits, the bar just moved. If the stock is trading 30% above the IPO price, which at the open it already was, for 5 of 10 consecutive trading days before that earnings release, an additional 10% unlocks early. The bar moved again. Then 7% tranches release at 70 days, 90 days, 105 days, 120 days, and 135 days. 5 separate release events before you even reach the big one. After Q3 earnings expected around October or November, another 28% unlocks. The bar is now considerably higher. Then the standard 180-day expiration in December releases whatever remains. Imagine a bar graph. On the left, a short bar representing the day one float. Call it 1 unit of supply. Now watch what happens to that bar over 6 months. After the friends and family sales, the bar just grew. After Q2 earnings unlocked, the bar grew again substantially. After the 5 staggered tranches, the bar grew 5 more times. After Q3 earnings, the bar is now dramatically taller than where it started. After the 180-day expiration, the bar reaches its full height. What started as a short bar representing 4% of the company has grown into something that looks nothing like the scarcity you bought on day one. The price discovery you thought was happening on June 12th was actually just the opening act. Now here is the structural problem. The passive buying demand, that $30 billion wall of forced index inclusion, arrives early. Around late June or early July, 15 trading days in. The supply expansion, on the other hand, is spread across the following 5 months. You have peak demand in week 3. You have expanding supply for the next 22 weeks. If you understand supply and demand, you understand why that sequencing matters. The Tesla playbook is instructive here. When Tesla joined the S&P 500 in December 2020, the pattern was textbook. Announcement pop. Run-up of 70% into the inclusion date. Concentrated passive buying on the inclusion print. Then flow exhaustion. Then sideways to down for weeks as the front-running momentum unwound. The buyers that drove the price up had finished buying. The sellers had not yet started selling. SPCX has a similar dynamic compressed into a much shorter timeline, except the supply calendar is explicit and public. I want to be honest about why this might not play out the way the data suggests. There are real reasons to push back, and I would rather give them to you directly than have you find them in the comments. The most serious objection is market efficiency. Lockup schedules are public information. They are in the S1. Any institutional investor with a Bloomberg terminal can model the supply calendar. The argument goes that the market already priced in the lockup expirations at the moment of the IPO. If that is true, the negative price pressure at each expiration event would be minimal because sophisticated sellers already hedged and sophisticated buyers already discounted. This is not a crazy argument. It is theoretically sound. Here is the problem with it. The academic evidence says the market does not fully price it in. Field and Hanka at the Journal of Finance examined 1,948 lockup agreements. They're finding when lockups expire, trading volume increases permanently by 40%, and there is a statistically significant 3-day abnormal return of negative 1.5%. That is the average. For venture capital-backed firms, the effect is larger. For high-tech firms with the greatest post-IPO price increases and the highest quality underwriters, the effect is larger still. SPCX is venture capital-backed. It is a high-tech firm and had a strong first-day pop. It used Goldman Sachs and Morgan Stanley. It fits every profile that predicts worse than average expiration effects, not better. A second objection. Musk is locked up for 366 days with 85% of the voting power. If the most important insider cannot sell for a year, maybe the selling pressure from everyone else is manageable. This is legitimate. Musk's lockup is genuinely long, and it does reduce the supply shock from the most visible holder. But Musk's shares are separate from the employee base, the early-stage investors, and the friends and family allocation. Those groups have different economic incentives. Many of them have been waiting years to achieve liquidity. The day their shares unlock is not an abstract date on a calendar. It is the day they can pay off a mortgage or write a check for a business idea they have been sitting on. They will sell. Not all of them, but enough. The third objection is the staircase itself. SpaceX specifically designed a staggered release to avoid a cliff event. One large expiration date is more disruptive than 5 small ones. The argument is that by spreading the supply, they reduced the damage. This is also true as far as it goes. Snowflake used a staggered structure in 2020. Its stock still fell roughly 11% over the final expiration window, and the broader first half of 2021 performance was down 14% from the highs. The stagger softened the blow. It did not eliminate it. And the stagger also means the pressure is not concentrated in one event you can easily identify. It is distributed across 5 months in a way that makes it harder to see coming as a retail investor. So what is the protocol? There are 3 executable steps. Step 1. Find your date. Pull up the S1 filing on SEC EGAR under registration number 333-296070. Locate the lockup section. Write down the Q2 earnings date when it is announced. That is your first major supply event. Write down the Q3 earnings date. Write down December 2026. Those are your 3 pressure points. You do not have to memorize the 7% tranches. The big supply events are tied to the earnings report. Step 2. Calculate your exit math before you enter, not after. Take your cost basis. If you bought at the open around the 27% premium to IPO price, you need the stock to be above that level at each lockup event for the selling pressure to arrive into a bid rather than into a vacuum. If your entry was at $162 and the stock is at $140 when the August unlock hits, you are holding through a supply wave at a paper loss. Know your number before August, not after. Step 3. Separate the company from the trade. SpaceX may be an exceptional business over a decade. Starlink has real revenue. Starship changes the economics of orbital access. The fundamentals may well justify a high valuation over a long enough timeline. But none of that changes what happens mechanically when $70 billion of constrained supply becomes several $100 billion of unconstrained supply over 6 months. The business thesis and the supply count are 2 different conversations. Conflating them is how people hold through preventable losses while telling themselves they are long-term investors. Here is the reframe. The 4% float on day 1 is not a number, it is a timer. It is set to run for 180 days, and every month that passes, more sellers gain the legal right to become sellers. The scarcity you saw on June 12th is real today. It is less real in August, it is considerably less real in November, and by December, it is gone. What you bought is not 4% or SpaceX. You bought a claim on a company that will be priced in a much more competitive market 6 months from now. And the people selling into that market paid a lot less than you did. The most expensive trade in markets is not the one where you are wrong about the company. It is the one where you are right about the company and wrong about the calendar. If you are a self-directed investor in your 30s, 40s, or 50s who manages your own account and wants to understand the structural mechanics that move prices, not just the headlines, this channel is for you. Hit subscribe. We do this kind of breakdown every week. Drop a comment below with the date you are watching most closely. The August earnings unlock, the Q3 unlock in November, or the final 180-day expiration in December. I read them because the answer tells me what kind of investor is in the stock. I am Thane. This is Salary to Strategy. I will see you in the next one.